Today I want to discuss on this question of November 2015. So we have been given the foreign balance were extracted from the books of Mike Moit as at 30 June 2015. We have the capital of 59,100, land and building 48,000. We also have office equipment 4,200, and then 9,000 office equipment. Office gross, we also have gross profit of 63,600, risk and insurance of 48,60. We also have bad debt written off of 330, utility 480, bad debts recovered of 420. We also have rent receivable of 14,160, provision for doubtful debt 1,395, personal expense for 20,730. Cash in hand 510, bank 660, discount received of 2,760, discount allowed of 2,400, accumulated depreciation on motor vehicle 1,200, accumulated depreciation on office equipment 3,105. Then you have trade receivable of 15,900, trade payables of 27,300, salary and wages of 24, 210, investment of 20,400, and sundry expense of 6,720. So in our additional information, we are told that as at 30 June 2015, inventory was valued at 14,640,000. This inventory included items valued at 3 million, which had been sold and invoiced to a customer on June 30th, 2015. So we are going to do some of the adjustment under this additional information. So first we are told that the inventories, this one, the 14 million, include already stock which was sold. So it is we are going to reduce the closing stock. So the effect on this additional information is that it's going to reduce the closing stock, which will affect the balance sheet on the current assets. Then the sale return day book had been overcast by 90,000. So here the sale return overcast is going to reduce our revenue. So it is going to also to affect our income statement. Then we have been told the discount allowed amounting to 360,000 had been posted to the discount allowed account, but not on the trade receivable account. So when you look at our trade receivable accounts, so it is going to reduce the receivables. So it's also going to affect the balance sheet on the current assets. So it is the 360 will be reduced from that receivable. I'm going to show you how we are going to do that. Then you also have depreciation to be provided as follows. Since here we are not being given any form of method, we are going to take it as straight line method. So for motor vehicle, we are going to depreciate it at 20%, office equipment 15%. So this one shall be expense in income statement, as well as they are going to reduce the assets in the net book value in the balance sheet. So it's going to affect both income statement and balance sheet in the non-current assets. Then rent received amounting to 300,000 had not been recorded in the account since the proprietor converted the amount for personal use. So the rent included of 300, it was used for personal. So it is going to reduce our income as well as increase the drawings. So meaning that it's going to affect both income statement and as well as the balance sheet on the capital side. Then we are going also to have the sale day book had been overcast by 400 and 450. So also this one is going to reduce our our revenue. So it is reducing the revenue. So it's going to affect the income statement, whereby now we are going to reduce it from our gross profit, since we have been given here. Then also the provision of doubtful debts, we have been given here provision for doubtful debts, which is 13,905 and 95. So this one, we are going to add the 1395 as a liability, which is reducing the net receivable. So it's going to affect the balance sheet on the liability side as well as on the current assets. So those are the adjustments that we need to undertake. So let's start with the income statement for the year ended 30 June. So this is what we are going to do in order to perform that. So we start with our title, which is Mike Moit income statement for the year ended 30 June. So we have our amount or figures in thousand. So we have been given the gross profit from our question, which is 63,600. So in our 63,600, we less now the sale return which were overcasted, as well as the sales day book which also had been overcast. So the sale returns were 90, as well as the sales from the day book which were 450. So that we get our adjusted gross profit to be 63 and 60 shillings. And then we are going now to add the our income as well as what we have received. So we have a discount received from our suppliers, which was 27.60. We also have the income which we have recovered from the bad debts. We have been given the bad debts recovered. Bad debt recovered to be 420. So we also add that. Then you also have to add the rent income. So from rent income, we had been given 14,160. Then the 300 was used for personal use by the owner. So the 300 shall be withdrawn, so that you get 13,860. So that our total operating income to be 80,100. Then we shall also reduce all the expenses. So for the expenses, from our trial balance, we have 4860, that is rates and insurance. We also have utilities. This is just given. We are going to copy and paste them. So as they are. So utilities of 480, bad debts written off, we had been told 330. Salary and wages 24, 2010. Standard expense, we also have 6720. Here there is no need for any working. Then we have depreciation. As you remember, we have said we are going to use the straight line method. For the motor vehicle, we have 20%. So at cost, it was 4,200. So we are going to get 840. For office equipment was 9,000 times 15%, we get 1350. So that we also have to less the discount allowed that we have been given of 2,400. So that we get the total expense to be 41,190. So our net profit for the year is 38,910. So this is what we are going to transfer to our capital or equity account. So this is all about the income statement. So you only need to do like that. So give you a minute so that if you have any question, please write it down as we continue. So let's continue to the financial position. So we start with the title for Mike Moit. So here are assets, we are going to have the cost, accumulated depreciation, and the net book value. So for the non-current assets, we have 4 of them. Land and buildings, we were told it's 48,000. So as you can check from a question, then it is not depreciated. So accumulated depreciation will be 0, net book would be 48,000. Then you have the motor vehicle. Cost was 4,200. Accumulated depreciation was 2040. Accumulated depreciation was 1,200, not 2040. So yes, it was 2040 because we are going to add the 1,200 plus the 840 from depreciation, so that we get a total of 2160. Then you also have the office equipment, which is 9,000. Accumulated depreciation was that 105 prior plus now 1350 for this year to get 4455. So when you less, you get 4,555, as you can see. Then you have the investment. Since we have not been told they are short terms or long terms, we assume they are long-term investment. So we add them here, the non-current, to get our total non-current assets to be 75,105. So that is all what you are supposed to do in the non-current assets. So let's continue to the current assets. So we are going to start with the inventory. So we have been given to 14,640, but we have been told that there is 300,000 that was sold, 3 million stock that was sold and invoiced to a customer. So we are going to less that. So we less the 300, so that you get 11,640. Then you also have the trade receivable. We had been given to be 15,900. Yes, 15,900. So that we also less the discount allowed of 360. So we less the 360. And this one should be 3,000, not 300. So we are going to get that. Let's first of all, so 3,000. So trade receivable is 15,900. You less the discount allowed of 360 to get 15,540. Then you also have cash in hand. These are given. Just copy them, 510, and cash in bank to be 660. So that our total current asset is 28,350. So the total asset will be 103, 105. Then we go to the equity, capital, and liabilities. So on our equity, the opening capital we have been told is 59,100. That is from our TB. Then we also have to add the net profit that we obtained, which was that 8,910. Then for the drawing, for the personal use, he had used 20,730, but he also used another 300. So you are going to add that, so that you can also be able to get allowed 21,030 shillings. The 3,000 that we have been told, the rent received amounted to 300,000. So he utilized the 300,000. So we are going to add that, so that we get a closing capital of 76,980. So for the liability, we don't have long-term liabilities. So we go direct to the current. We have the trade payables. We have been given to be 27,300. We also have provision for debts, which we have 1,395. We also have the rent received in advance. So this one we are terminating as unearned income, which we said it has to be on the liability side, on the current liability. So for the 300,000, So we add the total, we get 28,995. So this is the total current liabilities. So when we add capital and liabilities, get 105,975. As you can see, the two equity, the asset should be equal to equity plus liability, but here there is a variance. So in practice we need a reconciliation here. So the difference or the variance here, maybe we can say it's about the allowed in errors, or omissions in depreciations, maybe or provisions, flow, maybe all that. So we require a clear reconciliation here. But all in all, if you do this, you get most of the marks, and these are the formats and the logic to do it. So, and also remember that every double entry we have, or the double entry logic that we have, every change will affect at least two parts. That's why you are seeing that if it is the drawings or the drawings will also affect two parts, all that. So I think we are together up to that point. So if you have any question, please let me know, and also indicate it on the comment below. I'll get back to you, and any personalized coaching, let me know, or any question that you need to be helped with. So this is all for that question that we needed to do it. So thank you. I'll see you.